Is the Pramerica Life Wealth Maximiser plan truly the growth booster your portfolio needs, or could it leave your wealth underperforming? Let us find out the answer to this question through an in-depth analysis in this video. Hi there, welcome back to holisticinvestment.in, where we help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. Now, before analyzing this policy, let us first understand a few basic details about it. This is a unit-linked, non-participating individual savings life insurance plan. So some of the key features of the policy are: you get to choose an adequate life cover that matches your protection needs with multiple sum assured options available based on your entry age. And you can even enjoy flexibility in premium payments by selecting single, regular or limited premium payment terms. And you can benefit from reduced charges when you opt for higher premium amounts. So you get rewarded for long-term commitment through persistency units and wealth boosters at specific intervals to enhance your fund value. And you can also actively manage your investments with a defined portfolio strategy, allowing you to adjust based on market conditions. So life stage portfolio strategy helps to maintain a balanced allocation between equity and debt as per your age and changing risk profile. So these are some of the key features of the policy, and there are benefits like death benefit, maturity benefit, persistency units and wealth boosters. There are also 2 investment strategies and 10 investment fund options that you can invest according to your risk profile and financial goals. Based on that, you can choose. But as a unit link policy, there are also certain charges that they will charge you with, where they will deduct it from your premium itself, which are premium allocation charge, policy administration charge, mortality charges, fund management charges and discontinuance charge and switching charges. So ULIPs involve several additional expenses such as policy administration and all these other related costs. These charges make ULIPs more expensive compared to most other market linked investment products. Over time, they can significantly reduce your effective returns, thereby limiting your potential for wealth accumulation. So these are some of the drawbacks that you need to keep in your mind before deciding to invest in this policy. And there are some advantages as well. Like, you can use a systematic transfer plan to gradually move your funds from the liquid fund to your chosen investment funds every month. And you can boost your investment and life cover by adding a top-up premium. And within the defined portfolio strategy, you can switch investments and redirect premiums among the available fund options. And partial withdrawals are allowed only after completing 5 policy years, which are the mandatory lock-in period. And you can benefit from the fund conservation option to protect your fund value from market volatility. So at policy maturity, you can choose to receive your maturity benefits as structured payouts over a period of up to 5 years through the settlement option. So you can increase or decrease the sum assured within the permitted limits after the 3rd policy anniversary. And you can enjoy flexibility to extend or shorten both the premium payment term and the policy term as per your financial goals. So these are some of the advantages of this plan, and there are some disadvantages like no loan facility available under this plan, and liquidity is restricted during the first 5 policy years, and premiums are invested only after deducting applicable charges. So the sum assured may be insufficient to provide adequate financial protection for the family, and the returns are not commensurate with the level of risk involved. So these are some of the disadvantages, the drawbacks that we need to keep in our mind before deciding to invest in this policy. So now, as we have a basic idea about this policy, let us move on to the analysis part of the video, where we are going to conduct an IRR analysis based on the benefit illustration given in the policy brochure to help us make a more informed decision. But if you want to know more about certain aspects of the policy in detail, you can refer to the policy brochure. So now, for calculation purpose, let us assume that a 30-year-old male has purchased this plan with a sum assured of 10 lakhs, policy term of 20 years and a premium payment term of 10 years, paying an annual premium of 1 lakh. The maturity benefit will be the fund value, including the persistency units and wealth additions. So in the policy brochure, they have provided examples at 4 and 8% per annum return scenarios. These are only for example purpose and they are not guaranteed returns. So let's just assuming that this is for worst and best case scenario. Let us now calculate the IRR for these return scenarios. So at 4% return, the fund value is 14.33 lakhs with an IRR of 2.33% as per the policy's maturity calculator, offering negligible real value addition. And at 8% return, the fund value is 26.20 lakhs with an IRR of 6.31% as per the policy's maturity calculator. Even under optimistic conditions, the returns from this policy remain unimpressive compared to other market linked investment options. So, despite carrying market risk, its performance aligns more closely with low risk debt instruments, making the risk return balance unfavorable. In conclusion, investing in this policy could hinder your financial progress rather than enhance it, as the returns do not justify the level of risk involved. So, as we know that this policy is not giving us the desirable outcome that we needed, let us move on to a comparative analysis where we are going to take an alternative approach in which we are going to invest in insurance and investments separately instead of combining it under one policy like Pramerica Life Wealth Maximiser. So, here for life cover purpose, we have taken up a pure term life insurance policy with a sum assured of 10 lakhs, which cost us only 7,500 rupees annually for a 20-year term. So, in comparison, this policy requires an annual premium of 1 lakh. So, choosing the term plan saves 92,500 rupees per year, which can be instead invested to grow wealth. So, depending on one's risk appetite, the investment portion can be directed towards suitable options. So, if you are a low risk investor, you can choose debt instruments such as PPF, which is Public Provident Fund, and if you are a high risk investor, you may prefer equity instruments like the equity mutual funds. So, in PPF investment return scenario, over 20 years, the maturity value comes to 27.29 lakh, delivering an IRR of 6.58%. So, this is comparable to the 8% return scenario of the Pramerica policy, even though PPF is a low risk debt option. In equity mutual fund investment scenario, investing the annual surplus of 92,500 rupees in it grows to a pre-tax value of 56.46 lakhs. After accounting for capital gains tax, the post-tax maturity value stands at 50.72 lakhs with a post-tax IRR of 10.74%. So, if you have any doubt regarding how the equity mutual fund, we have calculated tax for equity mutual fund, you can see that we have presented a small tabular column on the screen for this purpose for your easy reference, which you can pause and see. So, this combined strategy of term insurance plus independent investment generates a larger corpus, offering better inflation adjusted returns and provide adequate life cover in contrast to Pramerica policy. Then what is the final verdict? Is investing in the Pramerica Life Wealth Maximiser plan worth it or not? So, this policy offers a market linked investment option combined with life insurance coverage. The maturity benefit comprises the fund value along with persistency units and wealth boosters. So, as an investor, you might expect this plan to generate inflation beating returns. However, an analysis of its performance shows otherwise. High charges significantly erode returns, preventing the plan from achieving meaningful long-term growth, and it also has a high agent commission. The plan fails to build a sufficient corpus to meet important life goals, and the insurance coverage provided is inadequate to serve as a reliable financial safety net. So, effective financial planning demands both comprehensive protection and strong wealth creation, areas where this plan falls short. So, overall, this policy is not a worthwhile choice considering the risk involved. So, there are better risk adjusted investment products available in the market that can deliver superior results. So, a smarter approach would be to build a diversified investment portfolio for wealth creation and to opt for a pure term life insurance policy for family protection. If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.